What's up, everybody? This is Alex Sylvia, IRA specialist at NuView Trust Company here, and today we're going to be talking about some approaching deadlines if you want to make a contribution to your IRA, HSA, ESA, 401k for tax year 2021. With most plans, you have until the tax filing deadline to make a contribution for the tax year that you're filing taxes for. So across the board, for the most part, your deadline is April 15th or whenever the tax filing deadline is. If the government decides to extend it by a day or two, if it falls on a holiday, falls on a weekend, they might push it back a day or two. So keep that in mind. That's when you will, generally speaking, have the opportunity to contribute to an IRA, HSA, ESA, or 401k for the tax year that you're filing taxes for. So for example, we're in the year 2022, and by April 15th, 2022, everybody's going to have filed their taxes for tax year 2021. So I can make a contribution for tax year 2021 as long as I make that contribution by the tax filing deadline this April 15th coming up. Now, when you're talking about employer plans for self-employed people like a SEP IRA, Simple IRA, or Solo 401k, you might be filing for a tax filing extension, which would then also increase the amount of time that you have to make a contribution to that type of IRA for the tax year that you're filing taxes for. So if I have a SEP IRA, I can make a contribution for 2021 all the way up until April 15th of 2022. But then if I file for an extension, maybe that pushes it back all the way to October, I then also have until October of 2022 to make a contribution for tax year 2021. All right, so in terms of the contribution limits for all these different types of accounts that NuView Trust Company offers, we're going to start with the personal plans simply because those contribution limits did not change. So just like year 2021, for year 2022, the most that you can contribute to a traditional or a Roth IRA, these fall under the category of personal plans, the most you can contribute is $6,000, and if you're over the age of 50, you can contribute an additional $1,000 as well. Next, I'm going to skip over the employer plans because those are unique amongst the different employer plans that exist. And then our specialty plans, just like the personal ones, those didn't change all that too much. So I do want to just get those out of the way as well before we get into the slightly more complicated employer plans. So the health savings account, that one, the contribution limit went up by $50 for year 2022. So if your health plan is a single coverage health plan, so it's just you, no family members on the health plan with you, and remember it has to be a high deductible health plan, you can contribute $3,650 to your HSA per year. Now, if you have family health coverage, a family high deductible health plan, you can double the contribution that you would make if you were a single person on that health plan. So for example, now you can contribute a total of $7,300, $7,300 to your HSA if you have family coverage, high deductible health plan. One other very important thing to notice about the HSA and to take into consideration is if you're looking to make that contribution for the HSA by the tax filing deadline 2022, to make that contribution for year 2021, you must have had that high deductible health plan in place by December 1st of 2021. So you may need to rewind that and go back to listen to that again to fully understand. But if you want to make an HSA contribution for tax year 2021, even making that contribution in 2022 before the tax filing deadline, the only way you're able to do so if you had that high deductible health plan and HSA in place before December 1st of 2021. The ESA, those contribution limits didn't change. So the ESA, this is our education savings account. You're opening this account if you have a small child or a niece or a nephew that you want to start saving for some education expenses, but you want to invest that account into alternatives, maybe something cash flowing that can build that account relatively quickly. This type of account is a use now account. You can use it for preschool through college, even trade school for things like books, tuition, iPads, computer, home internet sometimes. Anyways, this type of account, you can put in $2,000 per year per child. Okay, so now we're gonna get into the employer plans. Like I said, the contribution limits on these are vastly different than your personal plans and your specialty plans like the HSA and the ESA because they're for self-employed people. It allows them to put more money into an IRA so that they can generate a retirement account for themselves. So under the umbrella of employer plans, we have our SEP IRA, Solo 401k, and Simple IRA. The reason I order them that way is because the SEP IRA and the Solo 401k, the contribution limits on those are actually based on a percentage basis of the self-employed person's earned income for the year, specifically their net income. So with the SEP IRA, for example, we'll start with that one. Somebody that has a SEP IRA can contribute up to 25% of W-2 income or typically 20% of 1099 income. Now, 25%, 20%, that's all fine and good, but there is going to be a total cap at $61,000. And this is actually increased from the 2021 limit of $58,000. So this year, 2022, you can contribute an additional $3,000 to a SEP IRA. The SEP IRA also does not have catch-up contributions like other plans. So the traditional IRA, the Roth IRA, those both have catch-up contributions. The SEP IRA unfortunately does not. However, we do have a Solo 401k, which is primarily for self-employed people with no employees. This plan does in fact have a catch-up contribution. So this one, the catch-up contribution is $6,500, and that can be made as an additional contribution if you're over the age of 50. And for the 401k, it works very similar to the SEP IRA in the sense that a self-employed person, in this case with no common law employees, they can contribute up to 25% of their self-employed net income for the year, or typically 20% of 1099 income. Now, with the 401k, you might have the ability to, as the employee, make contributions separate from the employer contributions. And this is particular to the Solo 401k at NuView, just because the self-employed person, they're wearing two hats. They wear the hat as the employer and as the employee. So what that means for the 401k is if the self-employed person elects for this to be a feature of the 401k plan, specifically the Solo 401k plan that NuView offers, they can actually make Roth contributions under their employee bucket of money in that 401k plan. So the way that works is under the employee hat for that contribution, the self-employed person can contribute up to $20,500, and that could all be Roth money as well, so they have a portion of that Solo 401k plan. Not only does it have tax-deferred growth, but because it's a Roth bucket of money, it's going to have tax-free distributions when the person comes of age at retirement, and they've had the account for a certain period of time as well. That's what qualifies the self-employed person to be able to take tax-free distributions from that Solo 401k. So as the employee, that $20,500, which was an increase of $1,000 from the 2021 contribution limit of $19,500 to that employee bucket of money, like I said, that can all be made as Roth, but then we've also got the rest of that 25% of the earned income or 20% of 1099 income that the self-employed person can contribute on the employer side. Because like I said, they wear both hats. They can make contributions as an employee and as an employer. So on the employer side, if that person had maxed out that $20,500 on the employee side, now on the employer side, they can make up the difference between that $20,500 and wherever that 25% of W-2 income or typically 20% of 1099 income sets the total limit. So that's what they'll fill in with that employer side contribution. And just like the SEP IRA too, there is going to be a maximum cap at $61,000. Now, Solo 401k, different from the SEP IRA, actually does have a catch-up contribution as well if you're over the age of 50. The SEP IRA doesn't have that feature. Solo 401k though, however, if you're over the age of 50, you can contribute an additional $6,500 to that Solo 401k plan. The Simple IRA, our last employer plan, back in 2021, it had a contribution limit of $13,500. In the year 2022, however, that has increased by $500, and now if you have a Simple IRA, you can contribute a maximum of $14,000 for the year. Now, with the simple IRA, unlike the SEP IRA, similar to the solo 401k, is that you can make a catch-up contribution if you're over the age of 50. For the simple IRA, this is an additional $3,000 that you can contribute on top of the base $14,000 that you can contribute to a simple. Unique quality about the simple too is there is no income limitation. So you're not going to be limited to 25% of your self-employed earned income. You're not going to be limited to typically 20% of 1099 income that you can contribute to that plan. As long as you have that $14,000 as earned income, that ends up justifying that amount. So if you're self-employed and let's say you only make $5,000 of self-employed earned income during the year, you're going to be maxed out at $5,000 that you can contribute to a simple. But if you make $15,000, that's $1,000 more than the contribution limit. So based on the contribution limit, if you made that type of income, you can only contribute $14,000 to that simple IRA. So we just covered a lot there. What applies to you exactly, I don't know, but give us a call. We'll help you through the process, get an idea of what accounts might be right for you, what you might be looking at as far as contribution limits, what deadlines you're looking at specifically, and if you need to make a contribution for tax year 2021, it's very important that you at least get that account set up and have a consultation with one of the IRA specialists here at NuView. Give us a call, send us an email. We'll be happy to discuss with you further. If you've got any specific questions of how these things relate to you and your income or your taxes specifically, we always recommend consulting with a tax professional for that. So thank you guys. We'll see you next time.